Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya, Birla Sun Life Mutual Fund and Value Research. I'm Ruchira and with me is our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
There's a renewed buzz around small caps after the recent bounce. So naturally, the question comes up, is it the time to invest in small caps now? Well, Dhirendra, before we get into it, let's just set the context. Small caps are basically the smaller, faster growing companies of the market. Yeah.
And supposedly.
Yes, and also the most volatile ones, right?
Yeah. Most first time investors, they start with the league table. Which kind of fund, which fund is doing well. And more so in a rising market or a rising market which has lasted for a while. The smaller companies grow by leaps and bounds. And let me just describe you the definition of a small cap. Top 100 companies, large caps. Next 150, mid caps. All companies after that are small caps. There is a possibility that company number 251 might get classified as small cap, but it can well be a big company. And sometimes a company number 500 by market capitalization might look like a small company on a relative in this overall scheme of things. If you look at it from that point of view, there could be very large companies. There could be some global leaders who are ranked number 450. So small companies or the companies in which small cap funds invest may not necessarily be small. They could be small on this yardstick of the classification of SEBI. Second is that investors get very excited about small caps. Small caps have an unusual character that when markets crumble, they fall more freely. That's the general belief. That may not be absolutely true because there are different, now in the last 4 or 5 years we have seen that when the market comes down, sometimes the large caps are actually falling more because the foreign institutional investors have a sizable position in FI, in the large companies. And when they sell, or most of the fall is driven by their actions, the large caps in fact fall more than the small caps. And what is happening about the small cap, that the emerging ownership of individual investors through SIP into small cap funds is providing a very different kind of resilience. So this is something which we have to test in coming times, that are small caps that fragile? Do small caps crumble, or do they fall the way they used to? Because what happened in 2008 was an eye-opener. The market fell from the all-time high in January 2008, and market fell freely on the Sensex, more than 55%, came down from 20,000 to 8,500 points. But some of the small cap funds, and there were very few small cap funds then, but they fell by 70, 80, 85%. That was very scary. That was very alarming. If your 100 rupee gets reduced to 15 rupees at any point of time, however brave you may be, whatever time you may have ahead, and you don't need the money, it will scare you. And it will scare you very badly. It can scare you to drive you out of the market forever. Assuming that, it is unlikely to happen. But small companies are also more vulnerable. Economic cycles, these companies, smaller companies may not be in a position to withstand the cyclicality. And it may take much longer. And that can disrupt their earning cycle. So they are more risky on the business front. They may not be as risky as they used to be in the market because they were not very grossly underowned. Most investors get attracted to small cap because they have delivered the best return over a very long period of time. And in a sustained rising market, they also look at the top. And that is why investors get attracted to it. And when investors get attracted to it and new investors are attracted, a big decline in a brief period of time, they get scared. So my suggestion is that you don't have to necessarily invest in small caps to begin with, but it's very difficult to resist. So just in case if you have invested, keep a 5-year view, keep a 5-year time frame in your mind. Don't invest lump sum, do your SIP. And in between, if the market goes down, like right now, there will be a situation, like right now, last 1 year, anybody who has carried on with it, small cap SIP will be very disappointed. And I think he should not be disappointed. Make sure that you are going to continue your investment for 4 more years and feel happy that you are not buying as expensive as it used to be.
Yeah. So when it comes to small caps, you often say that better than asking when to invest, you should actually think about how much to invest. So what is the right allocation to small caps?
There isn't a right allocation. The right allocation is one which will be palatable. At Value Research, we used to do the market capitalization breakup before SEBI came with this official and a very rigid thing that top 100 companies are large cap, next 150. Before that, what we used to do, and that is still is the driver for the style box that you see on Value Research online for every fund portfolio, is that we add up the market capitalization of all the companies in the country which are actively traded every month. And the companies which account for 70% of the capitalization, they used to get classified as large cap in Value Research methodology. And that still continues. So top 70% capitalization is accounted for about 63 companies or so. Next 20% was mid cap, and the bottom 10% is small cap. So in our scheme of things, if you want to be if you want your portfolio to reflect that of the market, even through active management, small cap should be 10% because that is what the market cap is by Value Research methodology of things. But as the market has gone up, and some of these small caps by the definition of mutual fund mandated for them by SEBI, you can well have 15-20%. That will be about the same. But you have to understand that what is the risk and what is the risk that you have to withstand. The risk is not necessarily the risk of disappearing, companies disappearing. The risk is of volatility. Smaller companies are more volatile. And if you can withstand the volatility, and if you have the patience, if you have the discipline, maybe you have 30%. And you can withstand only if you have the experience.
All right. Now, let's address the big now in this question. Should you invest in small caps now? Are the valuations comfortable?
Mutual fund investors should not worry about valuation. And if you're concerned about valuation, you should not invest in small cap in the first place. For you, the real thing should be investing in a balanced advantage fund or a value fund. They will always be buying the relatively cheap companies because it's impossible to buy the companies at the most attractive price. And if you try and perfectly time it, even the fund managers are attempting to do it. They can do it in the balanced advantage fund, be tilted towards equity or less towards equity. And there is a flexi cap fund, which is nearly a quarter of the money is still in cash. So you can have a situation, but that the fund manager thinks that it is expensive or cheap and changes his allocation accordingly within the framework. But I think for an investor, new investors should not invest in small caps. Other investors, and a new investor should start with a flexi cap fund or a multi cap fund where there will be 25% of the money will be in small cap in a multi cap fund. There will be 10-15% in a small cap allocation in a flexi cap fund. Only once you have evolved as an investor, once you have been investing, been used to for 4-5 years, I would say that 5 years, then consider small caps, because the turbulence of small cap is not easy to withstand, is not easy to navigate. And it is very important for investors to configure themselves in a manner that you can stay there for the long haul. And for that, you have only 2-3 things. Diversify, invest regularly, and make sure it's a long-term money.
In a recent episode, when we were discussing small caps, you mentioned
get started with a balanced fund, get started with a small cap fund. It doesn't matter.
So what about that?
My rationale for the view that somebody should start anyhow, because when somebody is getting started, you are able to internalize excuse for yourself that this will happen, then I'll start investing. That will happen, then whether market is cheap, expensive, or you have some expenses lined up, or it's a procrastination, avoiding the investment process. And with that in mind, I would say that small cap funds still have great advantage. If you have to start investing, and if you are committing to invest for next 2-3 years by way of SIP, start in a small cap fund. Even there, and for a 20-year-old person, because the mindset of a person who is 45-year-old who has never invested in a mutual fund or a market-linked investment is very different from a person who is 20-year-old, got out of his college and starts earning 50,000 rupees. And his mental makeup is very different. His ability to withstand or see the turbulence in a different way is unusual. So I would say that doing SIP, being venturesome, investing in a small cap fund, and having a 3 to 5 year time frame, he is a gentleman. He is not speculating, and will end up being a winner. And there's a great possibility that he'll end up being a winner by a wide margin as compared to all the day traders, all the guys who are punting into stocks.
Right. Now, when it comes to investing in small caps, there are so many options available. How should one select a small cap?
Very simple. 3 and 5 year alpha in the universe. Okay. The funds the ones which are able to beat the benchmark. Because there is one great advantage of small cap which even the worst small cap fund will deliver. When we as individual investor go and invest in smaller companies, we end up with a garbage. We end up with a company which is basically in the news, in the noise, and is going up. And we don't get an opportunity to validate the credentials of those companies. Is it making profit? Is it doing something? Look at the IPOs that we are witnessing right now. They might have their fundamentals might be very suspect, but they might appreciate very sharply. Right. And people are investing with that in mind, finding a bigger pool. When it comes to small cap fund, you are getting a diversified portfolio of smaller companies managed by a fund manager. Even if he is unable to beat the benchmark and is unable to beat the benchmark by 10 percentage point, you will still end up being a winner.
Okay. So let's say someone who's already investing in small caps and the allocation over the years has gone beyond your recommended 20%. What should they do then?
Oh, my rules are broad framework. They are not a rule which you have, they are not inviolable rules that you have to necessarily follow it at all times. Don't over-engineer. If it's a good small cap fund, if you're not getting upset with the ups and downs, carry on. And let your winner, it's very important for investors to understand that when you cut your winners, because they have gone and allocate, it's a bad principle to have. Let your winners run. And don't cut your winners, because then the natural fallout is that you will actually be taking money out from your winners and putting it in with the losers or relative losers, if not absolute losers.
What about those who want some exposure but are too nervous to commit?
Get started anyway. The joy of having an investment which has done very dramatically well is also a desire. Most people are attracted to the market for substantially higher returns, for exceptional returns. And that is when they violate the basic rules of diversification, building a portfolio, being methodical about it, doing the health check, doing the basic validation. The small caps deliver you. Make sure that you have the patience. Make sure that you have the temperament. Make sure that you are not pretending to be a long-term investor and investing coming with short-term expectations. Because if you come with that expectation, then you will be very disappointed and you will not be able to tide over any declining phase.
Right, now you've told us how to select a small cap for yourself. What are the red flags that one should watch out for?
Looking for a small cap fund, the fund manager is very important because in the mid cap and the small cap, the universe is very defined. 100 companies and you have to choose from 150 companies. Small cap, the universe is 1,000 companies. And of the 1,000 companies, they are not very well researched. So a fund manager, when he builds a small cap fund manager, when he builds a portfolio, he has to really know companies intimately. And other funds, that is also very clearly visible in the small cap portfolios. Most small cap portfolios are very different from each other. And all large cap portfolios are identical to each other. Only the allocation changes. So the onus on the fund manager is very substantial. A fund manager changes, worry about it. If it becomes a huge fund, worry about it. If it is a huge fund and if it is not managed by multiple managers, worry about it. So I would say that look at the skills, look at this 3 and 5 years sustained alpha. And that is something which is an input which is used by value research analysts in their recommendations.
Right. Well, thank you for sharing your insights.
Thank you.
So, should you invest in small caps now? Yes, by all means, do that, but with discipline, slowly, within limits, and with a long horizon in mind. Because small cap investing isn't about timing the highs, it's about surviving the lows. That's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.